Hello friends, Chris Lee, CPA here, back with another video for you. And today we are going to talk about an S corporation becoming eligible for qualified small business stock purposes. So if you've seen any content online about what is, QSBS or qualified small business or Section 1202, you'll know that it's a really powerful tool that allows investors and stockholders to potentially, exclude up to 100% of capital gains for federal income taxes when selling a business, selling the stock of a trader business. So because you can potentially save so much, 100% of gain from taxes, everyone's always wondering, like, how do I get this benefit? Well, we first need to understand what the requirements are for QSBS. And the first thing is that the stock must be in a C corporation, which makes our S corporation tax status, a problem that we must deal with. And so we'll talk a little bit about that in a second, but just, to walk through it a little bit, we've got company qualifications, so what the entity itself has to be, and then we have shareholder qualifications, what the stock is to the shareholder, and then from there we can talk about workarounds that might be available. So first is for Section 1202 qualified small business stock, QSBS, the entity type itself must be a C corporation. So this can be an Inc., an incorporated entity, or an LLC that is treated as a corporation for federal income tax purposes. So S corporations and LLCs taxed as S corporations generally do not, qualify, but there are conversion options possible, which we'll talk about in a couple minutes. Second thing is that aggregate gross assets must not exceed 75 million before and immediately after the stock is issued. So we've got to target. So when the entity is formed, the capital contributed basically needs to be, not exceed certain amounts. And so that you make that consideration at every tranche of, newly accepted capital, such that you will be able to, identify if that $75 million threshold applies or doesn't apply based on when those assets are, contributed and the stock is exchanged for those assets. Third company qualification is that it must be an active business. So that is to say, substantially all of the holding period, at least 80% of the company's assets must be used in the active conduct of a qualified trader business. And then what is a qualified trader business? It's basically anything that excludes professional services, law, accounting, health, finance and banking, insurance, real estate, hospitality, farming, really anything that has to do with a person's reputation in providing the goods or services to the customer. So that's all to say the company qualifications. For shareholders, we must understand that there are, functionally two requirements. One, the shares must be original issuance shares. So you must purchase stock directly from the company in exchange for cash or property or services. You can have inherited shares or gifted shares or something like that, and those still meet the original issuance requirements. However, you cannot have bought the shares on a secondary market. Those will not qualify. The second is for shareholder qualifications, there's going to be holding period requirements. So the new legislation brought about this tiered structure that basically says for stock acquired after July 4th, 2025, if you hold it for 3 years, 50% of your gain is eligible for exclusion from federal income tax. After 4 years, 75%, and at 5 years, 100%. Stock acquired before July 4th, the effective date of the recent One Big Beautiful Bill legislation, is going to be subject to the original holding period requirement, previous holding period requirements of 5 years to get 100%. There's no tiered system. So the holding period does, get a huge benefit now that we're on the other side of the OBA legislation. But what we'll end up getting because of this, that's why people have so much interest in, how do I become, a C corporation? And then we also need to understand that there are redemption limits. So the company cannot have repurchased a significant amount of its own stock from you or other related parties within 2 years before or after the issuance of the stock. So basically, using the funds to buy out shareholders and that sort of thing. So those are the main requirements. Now, we're going to talk a little bit today about dealing with the C corporation issue, right? So lots of these items, we've got to think about how do we deal with them, if we don't meet the strict definition of the statute. So when we're thinking about the C corporation issue, we've got to think about, we're asking ourselves in the context of what happens with the S corporation. So if you've got an existing business that's operated as an S corporation, there are a couple options to kind of fix this so that you can get that C Corp, get the stock eligible for this QSBS benefit. So first thing to know, that stock issued by an S corporation cannot be qualified small business stock. So that's the first thing to know. If your stock was issued by an S corporation or an entity treated as an S corporation, when it issued the stock you receive is never going to be QSBS eligible stock, 1202 benefited stock. So we're going to have some workarounds as to how we get the consequence that we're wanting. So the first two options we're going to talk about have to do with, entities that have, only an S corporation history. They were never treated as a C Corp. Upon formation, they are instantly treated as an S corporation. So, and then the third option, we'll talk about an S corporation that maybe was for a period, had filing years of a C corporation, then became an S corporation, and now we're trying to go backwards. So the first thing is you can liquidate an existing S corporation and recontribute its assets to a new entity. So you could liquidate your existing S corporation by distributing all the corporate assets to you and any other shareholders, and then recontributing those assets to a new C corporation that meets the definition for the company requirements under Section 1202. So this is not something that you would necessarily do off the start, because S corporations or S corporation distributions are function like C corporation distributions when distributing property, in the sense that it's a deemed sale. So the assets leave the entity at fair market value, which triggers a hypothetical gain on those assets. So if the S corporation doesn't have a lot of highly appreciated assets, there's very little or no tax cost to such a liquidation, and recontributing those distributed assets to a new C corporation can usually be structured as a tax-free transaction. So however, if the S corporation has significantly appreciated assets, a liquidation would trigger taxable gains that would then be passed to the shareholders, but that tax hit would usually be only at the shareholder level. So you don't have two layers of tax, but you're going to have a taxable event. So you're basically, this is not, if you have a highly appreciated bundle of assets to be distributed and then recontributed again, you're basically locking in the gain for today, so that you hope that, in the next couple of years, that if it's high growth entity, that you're not going to pay, you're going to pay less tax in the future, because the more growth is going to be attributable to a QSBS period rather than to the S-Corp period, because you're creating this hypothetical sale. So that is to say, you kind of want to go with this with your eyes wide open, and you're going to have, to make a very different, the calculations will be quite different if you're talking about an S corporation that has significantly appreciated assets. Now, the second option is to basically use your S corporation to form a subsidiary C corporation that the S corporation owns. So S corporations that own stock in a C corporation, they can get that QSBS treatment that flows through the S corporation to the shareholders of the S Corp. So we've got a C Corp down here, QSBS stock in the middle of the S corporation. S corporation sells the stock with a QSBS benefit. It passes through on K1s out to the shareholders. And so that's how we, would potentially do that without triggering gain. We drop the assets down, or we drop cash down, transfer all those operations, and move them back up. So that's the function of it a little bit. In the structure, the S corporation forms, a new C corporation subsidiary, and the C corporation issues new stock to the S corporation, possibly other investors if you're doing it, in as a group of participants. But and if that C corporation meets all the other requirements, you know, the assets of 75 million, all those sorts of things, and you've got an active trader business, 80% of the assets used in the active conduct of a trader business, and it's not a prohibited industry, then you can get that QSBS treatment at the entity level. So when the C corporation stock is later sold, the S corporation, you know, calculates the gain, which it then passes to the shareholders, and then the individual shareholders would then be eligible for that QSBS exclusion under 1202, assuming all other requirements are met. Now, the important thing to understand is that when this S corporation forms a new entity, it can form it in two ways. One, it can form it with a cash capitalization down to the C Corp, which is, you know, it would look very much like if an individual started a C corporation. It's very clean, very tidy. The other option is that the S corporation will drop the assets down to the new C corporation, becoming its new parent. The S corporation basically has nothing going on except holding C Corp stock, and the C corporation is the new operating entity. This restructuring can be a tax-free transaction, depending on how you structure it. It can be under two different code sections. It could be, you know, a 360A1F reorganization, or it could be a 351, you know, capital contribution. The more technical terms there, but you can kind of think of it both ways. But if the new C corporation, you know, you can meet those requirements still by capitalizing the subsidiary C corporation with cash or assets. However, it's important to note that those assets you contribute to the C corporation. Basically, those assets that have kind of like a built-in gain, that if you had done the liquidation and then triggered the gain at the S Corp and then contributed them, the gain attributable to those assets that are kind of contributed into the C corporation, that gain is not eligible to be treated as QSBS. You're just deferring that down the road without triggering it immediately. The gain that's attributable to those assets after the QSBS period begins would be QSBS eligible. So only future appreciation in the value of the subsidiary stock after the transfer is eligible for the QSBS treatment. So that is to say, it's kind of a different version of the first of the liquidation. In the liquidation scenario, you're creating a taxable event on the front end, deferring the tax to later. On the second scenario, where we kind of drop our assets down, or cash, but dropping down the assets does kind of limit the potential for those QSBS gains. You're deferring the gain on those assets that you've transferred that have kind of like an appreciated value down into the C corporation. Now, our third option is a different flavor, and this is where you are converting an existing S corporation that was a C corporation to a QSBS. So imagine you have an entity that was a, you know, C corporation upon its formation, operates, you know, 1 to 20 years, however long. Then that S corporation revoke, it becomes an S corporation, operates as an S corporation, distributing K1s, all those sorts of things in its history. And then now you're wanting to achieve this kind of QSBS status. We were like revisiting this. So the simple way to achieve this is a direct conversion of your S corporation to revoke its S Corp status. So this requires, you know, consent of all shareholders who own more than half of the S corporation stock. So you have it was a C Corp, became an S Corp. Now we're going to revoke it back to a C Corp. What you get here is after the corporation's S status is revoked, it becomes a C Corp, like we were talking about. You make and then after the conversion, the original C corporation, you know, meets the definition of QSBS with the previously issued stock in the corporation. However, the interesting thing is that previously issued stock in the corporation will not be eligible for the QSBS. You will need newly issued shares from the entity to be eligible to meet the new to meet the new rules. So you and any other S corporation shareholders could contribute more cash or property to this, you know, new C corporation in exchange for newly issued shares that would then be eligible for QSBS treatment. So then what you get there You have two tranches. You basically have shares that were QSBS eligible and then shares that were not QSBS eligible. That's probably, if you've got the option, where it was a C corporation, begin as a C corporation, then later elected S, now it's revoking its S election. That's probably the, you'd kind of want to evaluate if that's really, necessary, if that's really what you're wanting, depending on the history of the entity. You'd also, what does it look like for other legal aspects, and then what other estate planning did you do with the S corporation that now might need to be reconfigured for the C corporation that you're trying to get this QSBS treatment, all sorts of things. So there can be things that you did with planning wise for an S corporation that you wouldn't do in this scenario, or you would have done differently. So when we're talking about unraveling these things, we've got to think about the fact that there can be nuances of where we would do things differently. And so in your overall plan, we've got to, map this out, not just thinking of like, how do I get rid of this one gain, but how do we make sure that we minimize lifetime taxes across the whole portfolio? And if we have, estate tax concerns that we need to think about, or if we're thinking about multi-generational planning, all those sorts of things. So yeah. Those are the primary ways, to do it. You can basically liquidate, pay some tax up front if you've got appreciated assets in your S Corp. You can form a new C corporation underneath an S corporation that is going to serve as kind of like a holding company of the C Corp. You can do that by contributing cash or contributing assets to this newly formed C corporation. The S corporation then distributes gain that may be eligible to shareholders. And then the third piece is, if it was a C corporation that became an S corporation, you can revoke that S election, make new contributions, and then those new shares could be QSBS eligible. But that's just a few thoughts on how we can make these things happen. Just understand it's not there's no perfect solution when it comes to kind of unwinding an S corporation to get these QSBS benefits. It's a powerful tax advantage tool, and we've got now partial and full exclusion on capital gains. Many states do conform in some way or another, but there are the higher tax jurisdictions really don't conform to the QSBS decision. So understanding that our benefits do need to take into the calculation that if we're in a state where we're going to have a 9% tax regardless, New York, California, those sorts of things, unraveling all of this, when we're thinking the cost benefit there, it does change that differential quite a bit. So all of these things take a sophisticated level of planning, with attorneys and accountants. So it's important to know that doing this analysis, if you're in a jurisdiction where you're not eliminating, a meaningful amount of tax at the state level, you just have to run the numbers and think about what's going to make the most sense. So yeah, after you evaluate the trade-offs, and particularly around tax consequences and elevating and shining, just know that there are some options that you can do it. If you do, if anyone needs to have a direct consult, feel free to click a link down in the bio and in the video description, and there will be a new video for you soon. All right.